Well, folks, we've officially kicked off the final trading week of the calendar year of 2025, and everyone is asking the same question. What in the world is going on with the market? If you rewind 1 month, everyone was feeling great and saying, hey, we're going to get a Santa Claus rally like no other. Fast forward to maybe a week or two ago, all of a sudden, everyone's calling for a cataclysmic sell-off into the end of the year. And then looking at the market now, well, we've had a nice recovery. So this is begging the question, are we still getting that bullish rally into the end of the year? Are we going to get that bearish sell-off? Or is it going to be something in the middle, like just a lot of chopped sideways, painful, hair ripping out type of action? Now, obviously, this goes without saying that if anyone definitively knew the answer to these questions, well, they would be a multi-billionaire and they probably wouldn't be watching this video. But for the rest of us normal people who can't tell the future, we have to do the best to kind of read the empirical measures going into this to get an idea of where the market might go. And that really brings me to the major point of this video, where Tom Lee, who recently has been calling out for the market to rip, and even in the face of the sell-off said, no, I'm looking for the market and Bitcoin and really, I guess, crypto as a whole to go higher. Well, they just brought him back on again to get his new revised plan for the remainder of the year. And the TLDR is bullish, but I really think it's interesting of what his reasoning is. And I think we should all really kind of at least pay attention to it. Now, I'm not saying what he says is gospel, but he does bring up some interesting points. So if you're like me and you're wondering where the market might be going for the month of December to wrap up the year, you might want to give this a listen. But very quickly, just add a little bit of framework to this particular discussion. I want you to know that I'm filming this at the start of December. The S&P 500 around 6,824, a gain of 15% year to date. Looking at the NASDAQ, a gain of 21%. Obviously, structurally, the NASDAQ 100 and the S&P 500 looking very similar. And even Bitcoin, as I'm filming this, getting a really nice pop off of 83,000 back to 91. But year to date, it is down about 1.5%. Like I said, just adding a little bit of framework to this particular video.
Joining us now is Tom Lee, head of research at Fundstrat and chief investment officer of Fundstrat Capital,
always gets
as well as a CNBC contributor. He's a calm person that doesn't get too excited or worried. But this is not a portentous start for December, given what you were thinking. Although I remember last time you were on, Tom, you said good year-end action, but rocky in the near term. That was about 2 weeks ago, and we've certainly seen that. But you still bullish on crypto and stocks?
Very quickly, before he answers, the most recent commentary from Tom Lee was basically, hey, I see the middle portion of November being pretty choppy. And then after that, looking for the S&P 500 to potentially get all the way up to 7,500. Once again, we're trading at 6.8 right now. And it was even calling for Bitcoin to hit a new all-time high, once again, before now and the end of the year.
I am. I think the biggest tailwind that's going to emerge in the next couple of weeks is around the central bank. The Fed is set to cut in December, but also today is the day that quantitative tightening ends. And as you know, the Fed's been shrinking its balance sheet since April 2022. It's been a pretty big headwind for market liquidity. The last time we had an end to QT, quantitative tightening, was September 2019. And if you look back at that period, the markets really responded well. I think within 3 weeks rallied more than 17%. So I do think the timing of QT ending, which is now essentially QE starting, and the Fed, and at a time when November kind of was topsy-turvy, so I think people got cautious, but now have to performance chase, and then you have a really typically a seasonal tailwind. So I'm pretty bullish into December, even with maybe the first day being rocky.
All right, let me add a little bit onto what he said, just so we're all on the same page. The Fed, monetary policy, Jerome Powell, that whole organization, on December 10th, we're going to be getting the next FOMC decision, where the markets, Kohrs and Poly market right now are saying that we're most likely going to get a 25 bips rate cut, as in lowering that Fed fund rate. So that is good. That means money itself is cheaper. So obviously that's a good thing in terms of the short-term bullish reaction in terms of the market. But what he's also talking about is QT. I'm not saying that you look good. Obviously you do look good, but I'm saying about the letters Q QT, quantitative tightening, which is literally the opposite of quantitative easing. Obviously, this could be a whole standalone video, but what you need to know is sometimes the Fed adds to their balance sheet and they're buying. That's helping everyone out because they're a natural buyer in the market. That is QE. But when they have to unwind that balance sheet, that is QT, quantitative tightening. And as Tom is properly pointing out, we're about to end that cycle of QT. So this should help with quote unquote liquidity concerns.
So it's still all about the Fed for you, because I was thinking there is a time when a market can hit an inflection point where the reason the Fed is cutting becomes a problem for the market. That's what I thought. With the jobs and everything else, there might come a time where purely Fed cuts or the backdrop is that there is some weakness in the market, in the economy.
What Joe is referring to is sometimes the market gets a little antsy when the Fed is taking defensive steps, as in, okay, why are you being nicer right now? Do you know something going on that we don't know about? Should we be worried? That's his concern, and that's what he's bringing up.
I mean, I'd say that the shutdown put a blackout on data, and I think that created a bit of anxiety because, markets like visibility. But to me, the fact that claims have been behaving and the September jobs report kind of showed a bit of a recovery. I think the labor market's probably holding fine, but the Fed doesn't want that to worsen. But I think the inflation story is actually weakened a lot. So to me, the Fed would be cutting for the right reasons, which is as they look at the next 12 months, the tariff inflation impacts are fading, but there's risk on the job market. So, I mean, I think it's cutting for the right reason, which is, real rates are tightening if they don't cut.
Here's what concerned me about a couple of weeks ago, Tom, with the market's behavior, and that was watching all of the AI high flyers dip and drop, and pretty precipitously in some cases, because it looked like the Fed wasn't going to cut. That raised questions about what was happening in the private markets, and it made me start to wonder, okay, are we looking at a lot of business models that don't work if the Fed doesn't continue to cut rates?
Fair question.
Are these the business models that are driving and powering the market right now? That's the one thing that made me sit up and say, that's a little different.
Yeah, I think there was a bit of soul searching, Becky, in November, because we know leverage rose, and we know there was deleveraging in some markets like crypto, and we know margin debt's high. And I think that there was essentially a reset in November because the market had a 6% decline, but the AI stocks and the meme names and a lot of other names fell even more. So I think that position reset has been healthy, and I think many fund managers we talked to in November, in the midst of all that, kind of threw in the towel, thought the rest of the year was sort of a write-off, and now if December is strong, there's going to be a bit of performance chasing, and I think that's what you should typically expect in the final weeks of the year.
When he's talking about the concept of performance chasing, right now a lot of money managers looking at the past year, 2 years, and 3 years are actually underperforming. So it's this idea that, okay, if we think there's going to be this Santa Claus rally, everyone might hop onto it, this quote unquote rally the train, just to get a couple more percentage points in terms of the return. So on a relative basis, all these money managers don't look so bad at their job.
When we saw Bitcoin sell off and sort of the high flyers sell off on the notion that Powell got hawkish at that one, whatever it was, that one meeting. And then Williams totally turned that around, and the Fed futures jumped, and it became clear they're definitely cutting again, and we got very little for that.
At the end of November.
Bitcoin should be back at 100 if it really is totally dependent on Fed easing, and if it's a debasement trade, which people say it is. We didn't get much for now. Everybody, you're sure that they're going to cut now. There was a time where we thought they weren't going to cut. What do we get for going back to cutting mode?
Yeah, I mean, Bitcoin and crypto have been disappointing because they really took it in the gut in mid-October and then kind of got hit again when, you're right, when the odds of a Fed cut dropped, Bitcoin fell. And then now that the odds have recovered of a cut, they haven't quite recovered. I mean, I think that that's still the lingering effects of that deleveraging that happened on October 10th. It's not that different than the wipeout that happened in 2022 with FTX. That took 8 weeks, so we're kind of emerging from that that's 7 weeks in the rearview mirror. So maybe in another week or two, I think crypto has fully washed out, and that's when it starts to participate.
Yeah, wipeout's a bad word. If you could pick another one next time, Tom,
Yeah.
we don't. You had very aggressive targets for the S&P and Bitcoin by the end of the year. I mean, it'd be crazy to hit the Bitcoin target, for example. I don't know what that was. But 7,000 on the S&P is still something you think that can happen this year.
He was calling for 7,500.
Yeah, I mean, 7,000 is only 2% for S&P. From here, I think 5% or maybe even 10% is possible in December.
What?
So I think a
10% rally
is likely for S&P.
Ask you not to do that. You're giving me a target and a time. Don't. It's not good for your career. Don't do that. You're going to be wrong one of these times. But you don't care, do you? You've been right enough.
Well, I'm just looking at probabilities, but you're right. We've been wrong plenty of times, Joe. So I'm okay being wrong too.
Okay. I never have been, really. I don't think so. That would be a big shocker. It happens to all of us. How about Bitcoin? Would you think you'd be happy with 100 if it got back by the end of December, wouldn't you?
Yeah. In fact, I think it was looking good, like you said, over the weekend, and then we got a decline. Sorry. Maybe because the Bank of Japan looks hawkish. Yeah. But I don't think the 4-year cycle, I don't think the Bitcoin high is in place. But you're right. We were too optimistic about this happening by December. But I do think Bitcoin can make an all-time high by the end of January. So I don't think
new
we should think the highs
by
are in place for Bitcoin or Ethereum or crypto. So a lot of it's going to depend on equities recovering, which we expect it to, and that helps the animal spirits. And I think a new Fed chair will help. And we have, as Becky said, when people got worried about a hawkish Fed, that kind of hurts the discount models, the discounted cash flow models like AI models, but it hurts crypto models too. So if we have a dovish Fed, that's really a tailwind.
Tom, is there a point, though, Joe and I were talking about this in the last block, is there a point where a Fed that's too dovish scares the markets because they're worried about inflation?
Yes. The markets don't want the Fed to lose credibility. And, and the bond market will kind of protest if the Fed is too dovish. But I think when I look at Fed fund futures, especially implied inflation, the bond market's more dovish than the Fed. So it looks like the Fed is behind. And that's why I think cuts are necessary.
Well, there you have it. Tom Lee of Fundstrat sticking to his guns in terms of the overall market, the S&P 500 for their final month of the year, looking for a 2 to 5 to maybe a 10% pump into year end. And even though he admits that we probably won't be seeing the best movement in Bitcoin in terms of a new all-time high this month, he is calling for it by the end of January. Obviously, this is a thought, it's an opinion, it is not gospel, which means I want to hear from you in a comment below. Do you agree with Tom? Do you disagree with him? Do you think the truth is somewhere in the middle? Like I said, let me know in a comment below. That's what I have for you today. I appreciate the good vibes. I'll catch you in the next one.